What is a loan assumption? Home buyers still struggle with low affordability, and that's when we as real estate agents start digging deep into our real estate toolbox to find maybe some old tools that we can use and dig up and help buyers, but also sellers move forward with their real estate transaction. If you like this channel and this kind of information, please press the like button, subscribe, and click the bell to get notified when we publish a new video. So, back to the assumption. Loan assumptions have been rare for the last 10 years. Why? Well, interest rates have continuously decreased. There was no need for them. But recently, with the significant mortgage interest rate swings, buyers and sellers have started looking a little bit closer at the possibility of loan assumption. Conventional loans are rarely assumable, and government-backed loans like VA, FHA, and USDA loans make up the majority of assumptions. VA loans are the most common loans for assumption, and combined with FHA loans, they make up more than 35% of all closings in the last few years. Lots of opportunity. For the sake of simplicity, all of the information in this post refers to a VA loan assumption. An important note, while I really try to be as detailed as possible with the information provided here, there can be variances with each situation. You might have seen information about VA loan assumptions elsewhere that conflict with the information below. This could be due to a local difference, a timing issue, or a transaction condition. Every situation for a VA assumption is unique. Therefore, it is important to reach out to your real estate agent to discuss your very personal situation. What is a loan assumption? A loan assumption is when a home buyer takes over the current homeowner's existing loan. A buyer can do this without applying for a new mortgage. That is a huge incentive. Instead, the seller's loan is transferred to the buyer upon the sale of the home. The debt liability is transferred while the mortgage interest rate and repayment period remain unchanged for the new owner. And that's significant. Why is a loan assumption attractive to the seller? A loan assumption can be a great solution for a home seller in an otherwise challenging market. In today's real estate dynamics, it's very likely that the interest rate on an assumed loan will be much lower than current rates. This can be a great selling point for a home. Assumptions also expand the pool of potential buyers. Buyers who might not qualify for the regular loan with today's interest rates could be more likely to qualify for an assumption with a lower rate. The seller might also be able to receive a higher sales price when a loan assumption is possible. Even if the buyer pays a higher sales price for the home, the savings from the lower interest rate and less expensive closing costs should offset this premium fairly quickly. Who can assume a VA loan? It may come as a surprise to you, but you don't have to be a veteran to assume a VA loan. Sellers need to keep in mind that the liability for a VA loan can be released after an assumption by a non-veteran, but the VA entitlement cannot be released. If the buyer defaults on the loan, the seller permanently loses the amount of entitlement tied up in the home. The buyer needs to financially qualify for the VA loan assumption, and the qualification process and standards are very similar to applying for a regular VA loan. Investors are not eligible for any government loan assumptions. Only buyers planning to utilize the home as their primary residence are eligible. VA loan assumption pros for the buyer. A low interest rate. The lower interest rate of the assumed loan means the buyer will have a much lower monthly mortgage payment. Less expensive closing costs. The funding fee on a VA assumption is just 0.5% of the loan amount. This is a fraction of the usual 2.3% on regular loans. A side note, veterans and spouses exempt from a funding fee for a regular VA loan are also exempt from the funding fee for a loan assumption. Seasoned loan. Depending on the age of the loan, the buyer will take over a seasoned loan. This means a larger portion of the monthly payment will be going toward principal. In the first few years of any mortgage, only a small amount of your monthly payment will be applied to your principal. As the loan matures, this amount slowly increases. You can easily see that in amortization tables. If the loan you're assuming is fairly new, this difference might be only pennies, but you'll save money with a lower interest rate for sure. Affordability. Today's interest rates are pricing many buyers out of the market, but even if a buyer can't qualify for a loan with the current interest rates, they might be able to qualify with the lower interest rate VAloan assumption pros for the seller. They can achieve a higher sales price. The buyer might be willing to pay a higher sales price for the home because there are significant interest rate savings over the life of the loan. The seller can achieve a higher sales price. The buyer might be willing to pay a higher sales price for the home because there are significant interest savings over the life of the loan. There's also no appraisal. A new VA appraisal is not required. The main financial hurdle to overcome is the additional down payment the buyer has to provide to cover the gap between the purchase price and the remainder of the loan. There are more potential buyers. The option of a VA assumption means the pool of potential buyers is expanded and the seller increases their chances of a sale in a challenging market. A seller can avoid a short sale if the seller is in danger of going into a short sale, meaning they owe more than they may receive in net proceeds, or if foreclosure procedures have already been started. A VA loan assumption might be worth discussing. The lender will need to approve the assumption and the seller will need enough time to complete the process. A loan assumption could prevent the seller from still owing money to the bank for the amount that they were deficient in the transaction. Or if the deficiency has been forgiven, they would owe taxes on income and it's a much quicker process. It's best to speak with us to see if this is a viable option for you. Here are the cons of a loan assumption for a buyer. It can be a very lengthy process. The buyer will need to bring patience because an assumption will take a minimum of 60 days. There can also be a larger down payment. The buyer will need to cover the gap between the purchase price and the remaining loan balance with their down payment. Depending on how the contract is drafted, this down payment could increase the principal payment with each month that passes until closing. Here are the cons of a loan assumption for a seller. Well, liability. Your legal liability for the debt does not automatically dissolve as soon as the assumption is complete. Sellers have to request in writing a release of liability from the mortgage lender or servicer. Without this release, the liability remains connected to the seller and poses an incredible risk. If the new homeowner makes a late payment or defaults, the seller takes a hit on their credit and is still responsible for the repayment of the loan. Release from liability. Have it signed. So what about the VA entitlement of the seller? If the seller's buyer is a veteran with sufficient entitlement, the seller could ask for a substitution of entitlement. This means that the VA buyer's VA loan entitlement will be substituted and then the VA seller's entitlement is released for another home. Failure to do this keeps the seller's entitlement tied up and unusable in the sold home and unusable for future purchase. The entitlement can also be permanently lost if the new owner defaults on the assumed loan. It's a lengthy process, I've mentioned it before. VA assumptions can take a minimum of 60 days, and this could delay the seller's ability to purchase another home. What is the gap? How much is the down payment? Well, the gap is the difference between the sales price of the home and the remaining balance on the loan. This is usually referred to as the gap, but it can be thought of as a buyer's down payment. It's vital for the buyer to calculate the gap to ensure that there are enough funds for the down payment. The buyer might have cash, pull it from equity in another property through a HELOC or a home equity line of credit, get a gift from friends or relatives, or get an additional loan. Second lien loans are more expensive, but as assumption increase, there is a good chance that lenders will offer more loan products that will cover this gap. How much does a VA loan assumption cost? There is a funding fee of 0.5% of the loan balance paid directly to the VA. It's not applicable if the veteran is exempt from paying a funding fee for a regular VA loan. The servicer will most likely have a processing fee and possibly a transfer fee. If an intermediary is engaged to navigate and possibly speed up the transfer process, they will charge about $550. This fee is usually subject to change. There are additional small fees that the servicer might require, including credit report fee, flood certification fee, and so on. Why does a loan assumption take so long? Assumption happens so infrequently that lenders are really not set up for processing them efficiently. Lenders don't really make money on a loan assumption, and so they're really not incentivized to have enough people and processes to speed things up. It's possible that this process will get faster if loan assumptions become more common, but until then, buyers and sellers will just have to expect a longer closing time. If there are third-party companies involved that help navigate and speed up the process as much as possible by staying on top of the correspondence and paperwork, that could help. Not all lenders are the same. Some will cooperate and work quickly while others drag their feet. Regardless, it will be extremely helpful to have their support of a third party that specializes in assumptions. How can you find a home for sale with a VA loan assumption? We suggest looking at homes for sale that were purchased before March or April of 2022, when interest rates were still so low. That is, unless the homeowner cash out refinanced the home before April 2022. Well, you can just contact us and we'll set you up with a specific search for VA loan assumptions on the MLS here in the Pikes Peak region and in the Denver MLS if you want. Just remember, you are looking only for homes with assumable VA loans. How do buyers find homes with a low gap? I've mentioned it just a minute ago. If you're searching for a property with a potentially low gap, I recommend looking for properties purchased 12 to 24 months ago, or homes that have been recently refinanced where the homeowner pulled equity out of the home. Here are some tips for a VA loan assumption. If possible, the buyer should run a mortgage loan process parallel to the assumption process, just in case the assumption ends up being denied. The seller should be aware that they will have to start all over with the selling process if the assumption is not approved. Keep in mind, the lower the gap, the more valuable the loan, and the higher the chance that you sell your home quickly with an assumption. The lower the interest rate, the more valuable the loan is for the buyer. Considering hiring a third-party company that specializes in loan assumptions to help navigate that process for and with you. Here is a seller's checklist for assumption. Provide this information to the listing agent because it will need to be disclosed to the buyer. Does the lender allow loan assumptions? Make sure you call and confirm. What is the remaining principal of the loan? You can potentially find that on your last statement. What is your interest rate? You probably know that already. And what is your monthly principal and interest payment only? Well, what is your monthly principal, interest, taxes, and insurance payment, also called PITI? Provide a copy of all loan documents with personal information redacted. It's best to ask the listing agent which documents of the loan package will need to be provided to the buyer once under contract. You also need to know how many total liens and mortgages are on the home. They also have to be taken over, they have to be released. The seller should review the following prior to engaging into a contract with the buyer. Well, is the buyer qualified? Does the buyer have enough entitlement to substitute for the existing entitlement? Does the buyer have proof of funds for the gap/down payment amount? And here's some questions for the buyer to ask. The buyer should review the following information prior to submitting an offer. And here are a little buyer points for an assumption. A buyer should review the following information prior to submitting an offer. Well, is the loan current? Is there confirmation that the seller's loan is assumable? Well, who is the lender, and does anybody have experience with that lender, how long that lender might take? What's the interest rate? And what is the payment, PI and PITI? Can the buyer afford the mortgage payment? That would be very important. And what's the gap amount? Does the buyer have enough funds for the down payment? Provide the seller with a qualification letter from a current lender. And provide proof of funds for the gap to the seller. That will make things so much easier.